So I did a transaction move in my portfolio. I sold one company and I bought a different one. Hey, welcome back to another video here at FiscalVoyage. My name is Felix, and today's video I'm going to talk about Foot Locker and Bristol Myers Squibb, ticker symbol FL as well as ticker symbol BMY. I originally bought Foot Locker in early March, February, and since then the company has came up to that price point. And I also made a video that I'm going to talk about in this video when I had the price of Foot Locker at around $20. So with this move, I not only increased my income, I also increased my potential annual rate of return for the next 3 years, 4 years. But before we get started, if you're new to the channel, make sure to hit that subscribe button, and as well check out my free ebook in the description below. Foot Locker stock analysis on April 20th. As you can see here, at that time on April 18, the company had a price of $2.89 and a fair price of, based on these estimates, $37.87, undervalued by 65%. And I gave it a buy recommendation for that day. And since that day, Foot Locker, since April 17, because I made that video on the weekend, you can see here from April 17, the company is up 54.13%, up $12 since that video was created. However, I didn't buy Foot Locker in this time period. I actually bought Foot Locker around beginning of March, I think. So as you see here, here's one of the times I bought Foot Locker. I bought it in the beginning of the year in January, and then I bought more in the beginning of March, and then I bought one more in April 8th at $23. So the price was going down. But of course, this was before the economic shutdown, which happened, or the low of when it was March 23rd. I think was the low of the shutdown. But I bought it at, which I thought was a good price. Then I made the video on April 20, which was even a better price, and that's why I had a buy recommendation. Even at this time period, I had I thought it was a good price. And I bought it at that time because it was a good price and the company was doing real good in earnings, just the price was down, think to uncertainty when the economic and such, but then it just kept driving the price down. And then I sold it right here for a nice little profit. I sold it more than what I paid for. As you can see here, I only bought 4 shares at a higher price, but most of my shares was at a lower price at $33.64, and I sold it today at $34.85. So I made a nice profit as well as collecting a little dividend here. And the main reason for selling Foot Locker was because of the dividends cut that they announced. So you see here on August 21st, Foot Locker declared a 15 cents a share quarterly dividend, a 62.5% decline from the last dividend announced in February. So that dividend cut, hurt. They have the free cash flow. We'll look at the fast graph shortly. They have the free cash flow. Earnings was looking good. Maybe I think they're going to grow it back, but because of the fact that they cut it and the price has gone up since that video, and since my purchase price, I'm in the positive as of today, I decided to completely sell out of Foot Locker, because not necessarily because of the company, but because of the fact that they cut the dividend. And I purchased other shares with this the money, the capital, and I increased my dividend income yearly, and as well as I invested in a very undervalued company. So you can see the fast graph for Foot Locker. Earnings dropped tremendously, of course, with the economic shutdown and the store closure. 62% decline in earnings from $4.93 in fiscal year 2000, because of the fact that the fiscal year ends in January. So they're actually now in fiscal year 2021. Estimates at $1.85. So the 62% decrease over last year earnings. However, but if we look at the free cash flow, first operating cash flow, you can see here operating cash flow looks good, estimates, as well as free cash flow estimates. So free cash flow, over the years has been tremendous. This is the reason why I bought this company, because the dividend looked very, very safe. Even in 2008, 2009, They increased the dividends in 2008 to 2009, but froze it for 2 years, 2010 and 2011, but then it started to increase it very nicely. And you can see the free cash flow very much well cover the dividend. And even estimates, analysts are expecting the free cash flow to be about $2.13 versus $1.52 in dividends. So we look back at the adjusted earnings and shorten the time period. You can see here the tremendous jump in value from the lows of March to yesterday's closing price or Friday's closing price of $34, and it's up $2 or 2%, excuse me. Here you can see here a 54% return since that time period. But if we look for the future, it still has a nice annual rate of return of 25%. So those of you that, if you were to bought Foot Locker at this time period, I think now and in this period, because you're up like 50%, I actually would continue holding it because so that you could take the profit as a long-term capital, tax of 15% versus a short-term tax. The reason why I sold it now is because I'm slightly over my price. So I made a little profit, but not too much. It's about like $100 in profit. So that's the reason why I sold it, because even though it's short term, but my profit wasn't tremendous. I just took out the money. I didn't lost any money, made a few profit, and I decided to buy an undervalued company with that. But if you were to buy it in April, when I made this video, you're up 50%. And I think holding it until the next year for a long-term gain is a better move. Unless you have it in a IRA with a tax-deferred account, then you could sell it today because of the dividend decrease. So I used that money to buy BNY. I bought 32 shares, as you can see here, September 14 at $59.12. I had some extra money in my account, about $400 in dividends that I also used to buy more shares of BNY. So let's look at the fast graph for BNY. So this is one of the main reasons, and I've made a video talking about more in depth of this company, BNY. As you can see here, earnings are expected to grow very nicely, 33% for 2020 and 19% for 2021 and 9% in 2022. So very nice growth. If we look at forecasting, earnings are, as you can see here, analysts about, there's 15 analysts, 13 analysts for 2022. So a lot of them are expecting high earnings growth, and they're pretty accurate. If we look at the summary, they've hit it or the company beat it basically all the time. There's never been anything lower than their estimates. So that's very promising. So as you can see here, if we were to follow or go to a earnings of 15, which is very unlikely right now, you could have a total annual rate of return of 39. But I think a earning ratio of about 13 should be more reasonable. And even at 13 PE, you're gonna have a nice rate of return. So let's look at here at 13. You can see here expected total annual rate of return about 30%. So not only did I sold my Foot Locker shares and bought this company, I also increased my dividend. As you can see here, the company has a dividend yield of 3.05%, and they should be announcing another dividend increase, I think, sometime this year. And the most recent increase was 10%. Let me look into that first. Yeah, so here you have the last increase, which was December. So actually the next increase should happen sometime in December as well. And you see the company announced a 9.8% increase for December. And I see no reason why this company won't increase the dividend by another 9% or 10%. As you can see in the fast graph, earnings are expected to grow 33% year over year. So there's definitely no reason why the company wouldn't grow the dividend at maybe at 8%, 9%, or even low double digit. So this is one of the main reasons why I bought this company. Not only did my income increase because now I have a dividend yield of 3 versus the I think the 2%, but because I bought it a little higher, it was at 1% because of the dividend cut. And not only did I increase my income, I also increased the profitability of potential profitability about total annual rate of return of 30.8%. So this is one of the big reasons why I switched to I sold Foot Locker for a nice little profit, and then I sold it. I bought BNY here. So there you have it. Those are the transaction I did this morning. I sold Foot Locker. I made a nice little profit there, but I bought BNY, and the potential future profit is going to be much more higher than Foot Locker. Again, if you bought Foot Locker when I made that video, I think if it's a taxable account, continue holding, because I think the company is going to go higher, but sell it later on because of the dividend cut, because your income did decrease because of that. But the company does look good. I'm just happy that I was able to cut out basically almost even. It was like $100 profit, and use that money to buy a much better company in Bristol Myers. But if you bought Foot Locker in a taxable account, I think now is a good time, not a taxable account, but in a deferred taxable account, I think now is a good time to buy shares. But if you bought Foot Locker in a non-taxable account, I think now is a good time to sell and purchase undervalued shares of much better quality company that didn't cut this dividend during this time. So thank you for watching. Again, if you're new to the channel, make sure you hit that subscribe button, and my free ebook in the description below. Make sure you check that out. Thanks.